Hello everyone, welcome. My name is James Harding. I'm an editor and one of the co-founders here at Tortoise. I've grown up as a journalist. I worked at the FT, then the Times and the BBC, and there is one supposedly cardinal sin amongst journalists, and that is what's known as throat clearing. And the idea of throat clearing is that before you actually say what you're supposed to say, you sort of warble around for a bit. I'm going to commit one of the cardinal sins. So here comes some throat clearing. I want to say thank you. There are a whole bunch of people who haven't been to a Tortoise Think-In before. A big welcome to you all. The aim of Tortoise was to be a different kind of newsroom, to try and make sure that we weren't adding to the noise, we weren't about more breaking news, we were actually trying to understand what's driving the news. In that spirit, my colleague and fellow editor Giles Whittell writes a daily email called The Sensemaker. And it's about trying to make sense of what's happening every day so that you're not addicted to the latest headlines, but in a calm and concise way, understand what counts. He's the editor of The Sensemaker, and given this pandemic, we thought to ourselves, let's try and take that exercise and make it live, make it in all of our journalism open, and hence we have this every week, a Friday lunchtime Sensemaker Live, where we try and take an issue and make sense of it together. So I just want to let you know how a Think-In works. It's like an open news meeting. The idea is everyone weighs in and tells us what they're hearing, what they're seeing, what they think. There's one really rather loosely enforced rule, which is no questions. We want to hear your point of view, your experience. If you've not been on a Zoom call, and probably everyone has been on more Zoom calls than they ever thought was possible, but if you've not been on one, you just need to see there's a chat tab. Type into that what you think, what you want to examine, and at the bottom of the screen there's also something that's the participants tab, right? And if you look at that, at the very bottom of that screen, there's a little grey box that says raise hand. If you click on participants, you'll see the thing that says raise hand, and look at that. There's my colleague, co-founder, Katie Vanek-Smith, who's putting up her little blue digital hand. And Nicola Stanhope, who's one of our great members, has done the same. You'll put up the blue hand is a way of just catching my eye and saying, I've got something to say here. If you haven't been to a Think-In before, please take me at my word. We really want to hear from you. We've got some brilliant people. I'm going to come to them in half a minute, but do just weigh in. We want to hear from you. Two other things I wanted to say. A big welcome to everyone who's worked with Brent and his whole gang at Founders. You know, Founders Forum has been a great sort of partner to us as we've got going. I know there are a load of people here who've worked with Founders, and it's helped them think about how they face the challenges of being a successful startup and doing so with a sense of humor and a degree of sanity. And so thank you to Brent for joining us, and thank you to the Founders team for bringing on so many of the people who are part of that Founders family. But also a big thank you to Jeff Lynn. If you know the world of Seeders, they're an amazing community of people who really do invest in startups and really do make it possible for people who've got great ideas to realize them. So I'm really excited that Jeff Lynn from Seeders is with us too. And then one final thing, when we started, we were lucky that we had a partner in Santander, the bank, that really did care about trying to make sure you could get a new business up and running. Happily, they were partners to us, and they've been our partners here on Sensemaker Live. So there endeth the great exercise in throat clearing, but I wanted to get all those thank yous in because I knew that when we get to the end of the hour, I would have forgotten. All right, I'm going to start, if I might, just by coming to you, Brent. And I know that today's Think-In is really trying to address what's happening in the economy. I have to say that personally, I've gone from being sort of alarmed to really, you know, really quite deeply anxious about what's happening in the economy and what the possible ramifications of that might be. Before we get into the details of thinking about what life is like for startups in lockdown, do you want to talk a little bit about what you think the big macro picture looks like, what you think the outlook is for the next 6 to 18 months?
Sure. Look, thank you, and thank you for the welcome to Founders Forum as well. I'm not a guru on the macro side of these things, but so I'll talk more when we come to the startup thing. But to answer the question, I speak to lots like you, lots of very smart people who are very bearish. The first thing is they cannot understand the stock market right now. The fact that I think we're only a few percent down off the peak seems a bit crazy. So obviously, you know, that said, what that does mean is that the markets do believe in the fiscal stimulus. And, you know, so I think that the next point on that is it working? And that's one of the things we'll go to later. But to me, that is a question of, are we able to distribute, if we're talking the UK in particular, is that money getting out fast enough to the right people? So I think that's a question we could delve into. And I think clearly the answer is not yet, although there are lots of very good initiatives ongoing, but we're obviously a lot slower at dispersals than other markets. And look, I do think I think people, it really does depend on the science, right? On what we think on the long term. And this is the fact, is that for businesses, there is so much of an unknown here. Look, the optimistic thing, I saw an email from one of the UK's big companies yesterday where they were talking about where life is getting relatively back to normal. And they were covering, you know, looking at Austria and Germany and those sorts of lockdown lifting. And look, we're not going to go into the details of it, but I think there are some people saying, look, we may only have 10% of people in this very long state of lockdown. And that would be a wonderful outcome, I think, and be a very optimistic outcome from where we're standing. But right now, look, you don't need me to cite the GDP hits, the unemployment hits, how dramatic it is, and the amount of companies who've seen demand plummet. I think the sort of broad analysis I've seen is that the sort of COVID stuff in the tech world is sort of good for 20% of companies. So there are 20% of the tech world, and that's a great number for overall, but that would be much worse in the real economy. But, you know, when one bumps into restaurateurs and retailers and stuff like that, you see how deeply concerning this is.
But I mean, Brent, frankly, it's interesting even that it's just 20% of the tech world. I think there's a mindset out there that, you know, if you're an innovator, somehow this is innovation's moment, and therefore a lot of people are going to be able to make the most of big structural changes and the move of so much of our economy online. I'm going to try and just get a sense of sort of context from everyone, also from some of our sort of key thinkers on this. And actually, before I come to Jeff, I'm going to ask Kathy Grimotka. Kathy, you work at Downing. You've got exactly that same issue that I imagine many on the call do, which is trying to make a judgment on whether or not this is going to be a V-shaped recovery, this is going to be a long, low bathtub. You know, how is it going to split sector by sector? Do you have, at the moment, a view on what the medium and longer term outlook is, or are you taking the view it's just too early to tell? Let's talk again at the end of June.
Yeah, pretty much that. I wish I'd had a more interesting response to that, but our view is there's so much uncertainty, we just don't know.
Right.
We're taking it much like our portfolio companies on a daily, weekly basis, with forecasts being revised as new information comes in.
Can I, the reason I'm interested by the end of June thing, though, is that I had a conversation with someone who runs a big professional services firm in the UK who'd had a call from a private equity company that says, look, we don't think we're going to do anything in May and June, but tell your people or your relevant teams not to take summer holidays in July and August, because we're going to have to allocate some of the money that we're sitting on. And at that stage, we're going to have to get our skates on. Within Downing, do you have that view, or could you just sit out the year? Do you think, oh, well, actually, at some point, we're going to have to start making some moves?
Yeah, so that's a really interesting point, because so for people who aren't familiar with Downing, we invest from EIS and VCT funds, and because of the nature of these funds,
VCT funds?
EIS and VCT funds. Yeah, and there's the point we're not allowed to sit on the cash for more than, I think it's 12 months, which means that if we now took the view that we need to, let's just pause for 3 months, we'd get towards the tail end of the year, and before the tax year end, all of a sudden we've got several millions to deploy, which is just unreasonable. So we're very much operating as much as possible business as usual and progressing deals, albeit naturally, with the adjustment of not being able to meet people in person, not being able to do our due diligence as usual, physically going to the offices, that has had an impact on the pace at which we're moving things through. But we're absolutely not sitting on our hands, and we're seeing that across our peers as well.
Interesting. Okay. Kathy, I'm going to come back. And by the way, please, people, don't be shy. If you've got things you want to say, just weigh in, and I'll start bringing you in as soon as possible. But Jeff, Lynn, will you just start us off by giving your view? I mean, you've got the responsibility that you've got this marketplace for investors, and they're going to be thinking to themselves, if they've got money, surely there are going to be opportunities now. At the same time, they don't want to go too early. So what's your view on the broader economic outlook?
I may still be muted.
Yeah, no, we've got you.
Now I'm on mute. Excellent. Yeah. Well, quickly, just before I answer, I'll do my very quick bit of throat clearing. First, just to say, James, great to see you. Thanks very much for having me on. And second, to the commenter who expressed disappointment that I'm not the Jeff Lynne from ELO, I am very sorry to all of you. I think you are more than happy not to hear me play guitar then. Look, on the macro side, I am bullish, actually. And I'm not delusionally bullish. I think there is no question that the next 6 months are going to be very hard for a lot of people. I think 2020 in many ways, certainly in tech, but I think in, across the business landscape, across the SME landscape, is going to be sort of a lost year. And I think we have to face the consequences of that. But I do think we're going to see something of a V-shaped recovery, or a narrow U, or whatever you want to call it, as we get out of, as the science gets closer and closer to providing solutions that we need. And I think that unlike the last financial crisis, where there was so much interlinked, that we saw so many years of unpicking before we really got back onto stable footing, I think we will return to relatively stable footing, in reasonably short order. So to me, I see 2020 as being about a survival year. Across the spectrum, it is about how do you keep good, otherwise healthy companies alive and ticking over to the extent they need? How do you keep individuals, alive and housed and fed, and all these very difficult challenges? But I think once we get through that, I think we're going to see a great set of opportunities, not driven specifically by the COVID, although that may be part of it, but certainly, driven by the reopening of the economy.
And how worried are you about, and we're sort of getting to our theme now, about the state of the startup economy? And I suppose I'm thinking not just about, if you like, the young startups who are obviously not yet at or probably near profitability, but those ones who are just cresting, they're just getting to the point where their businesses are viable, and then they're seeing such a demand shock that they could be wiped out. So I guess what I'm asking really, Jeff, is the forecasts that have come from the IMF, that have come from the UK, from the Office for Budget Responsibility, propose what you're proposing, which is that we're going to see a V-shaped recovery, as long as there's not such significant scarring of the economy, as long as there's not such significant destruction of businesses and jobs, that we can actually bounce back. How worried are you when you look at the startup and, growth business world, that we are going to see those businesses shut down and the economy scarred?
Well, I'm certainly very worried about the next sort of 6-9 months and companies making through it, because you're right. I think, if not unique, but an important feature of the startup world, tech and even not so tech, is that businesses tend to run on fairly lean cash, are often dependent on venture capital and other forms of external investment that may become somewhat less available. It's interesting at Cedars, the data so far has been fascinating, that actually after an initial dip, we've seen our investment levels return to normal. It's very difficult to know the extent to which that is being replayed elsewhere in the early and growth stage investment ecosystem, but I think it does seem like there's a significant slowdown in general in terms of this form of investment. And so I think with limited cash balances, revenues declining, and a dry up of private investment, we potentially have a real problem. But I also think that if we can get across the bridge, look, you're right. If the economy is so deeply scarred that it takes years to come back, then almost no amount of kind of patchwork is necessarily going to help, and we're going to be in for a much more cataclysmic moment. But if my view is right, that we will pull out of this once the economy reopens, then my concern, and the way I look at it today, my concern really is about how do we get through this next 6, 9, 12 months so that businesses that have built great products, that have built great customer bases, but that are now largely slowing down or hibernating, how do we make sure that they come out of it in strong shape and able to capitalize on 2021 and beyond?
Okay, Jeff, thank you. I'm going to come to, if I can, to Gerald James. And in a moment, I'd like to also just pick up on the point that Julian Asher has made about whether or not we think that these new habits of behavior are going to last. But Gerald, I see you've made this point in the chat about what's going to happen in terms of VC behavior and what you're hearing from the West Coast about what venture capital might do. Are you there? Can we come to Gerald and hear?
Yeah, I'm here. Good afternoon. Can you hear me okay?
Yeah, hear you fine.
Good. Yeah, I was talking to one of the VCs I know out in the Valley. I've been going out to the Valley for 26 years every year just to find out what's going on. Their view was that there will be some winners and losers, pretty obvious, teaching your grandmother to suck eggs in that respect. But what their view is that VC returns are still probably the best form of investment that is going at the present moment in time. They're able to raise funds for their fund. They're able to find portfolio companies to invest in. Their view is that there will be some winners and some losers. There will be some new norms as we come out of this. And indeed, I was reading Mary Meeker's report yesterday, Our New World, which the view tends to be, the world is going to be different moving forward from where we are at this moment in time, and new startups will emerge to service those new norms. Yeah. They seem quite bullish, to be honest, and I've got another call with another friend of mine out there early next week. It would be interesting to compare. They tend to be more late stage investors, so it'd be interesting to compare their view to an early stage VC investor.
Gerald, thank you very much indeed. In fact, that leads sort of perfectly to the question or the point that I suppose Julian Asher was raising. I don't know, Julian, whether or not you want to make it, whether we can come to you. If someone asks you to see if I can put your screen on. Are you there?
Okay. Yes, I'm here. Can you hear me?
Yes, hello.
Okay, hello. So I'm an early stage investor. I'm based in London. And I've noticed I've been getting a lot of pitches from startups that are sort of pitching their remote working or remote education products as sort of big game changers. And they are seeing, you definitely do see a bigger uptake of those things now. But the question is this sort of a flash in the pan, or do we think that this is going to presage a sort of a permanent change in the way that people are working? And if so, then those sectors, or those opportunities will be much more attractive than just like, it's a temporary thing that's happening now, and then we'll go back to the way things were.
I think this is the sort of question that you wonder about, not just, I suppose, in a business sense, but yourself personally. Are we going to spend less time in our offices? Are we going to do more by video conference? Travel less? It's such a question. I'm going to put it, if I may, in a moment to Brent Hoberman, but first, can I actually ask Czech Warner? Czech's a co-founder of Ada Ventures. She's masquerading here under the name of Francesca Warner, but there you are, Czech or Francesca, whichever you best go by. What's your view of this, of whether or not we can even begin to make a decision now about the investment criteria for startups, those that are pitching a kind of change world post-lockdown?
I think most startups have either fully pivoted or to some extent pivoted to at least sort of factor in this massive, global phenomenon that's going on. So whether it's just that they're introducing a bit of a kind of COVID strategy, or whether they've completely changed their entire business, as I've seen some companies do, to completely focus on this. I think everyone is kind of adapting to the crisis, but yeah, I think it is anyone's guess how long this kind of behavior change is going to last. And my fear is that there are some opportunistic companies that are just throwing the towel in on what they were actually doing before and probably doing quite well to focus on COVID. And actually they're going to come out of this and realize that it's not a sustainable business, or it's not something they're authentically passionate about. And I think that investors can see through the opportunistic businesses quite quickly. So I think, what we're seeing in our small portfolio at Ada, which is only 4 companies, is that, there's one company that has been very, very badly impacted and 3 that have actually done better in the 20%, I think that Brent was talking about. So I think it's still unclear at the moment whether that 20% is going to persist, or whether actually there are going to be kind of longer term winners from this behavior change that we'll see if this goes on for the next 6 to 12 months, which it looks like it probably will be.
Okay. Brent Husband, can I come back to you on this? It's easy, I suppose, if you're right at the very beginning of thinking of your new business, to try and imagine it, in the context of what's happening now. But I suspect that a lot of people, the vast majority of businesses are, I just saw Martin Ricks's comment, he's actually quite looking forward to getting back to work and to quote unquote normal life. This is a gut thing, there's not a metric for it. What's your gut on how much we're really going to see fundamental changes in our living and working practices when we don't have the threat of COVID-19?
I think it's more, so going back a bit, is that, one of the smartest investors I was talking to the other day said, so going back to some of the previous comments, said that really what he always invests in, what's the world going to be like in 5 years' time? So not a year or 2, but 5 years. And his view is that he's pretty confident that by 2025, COVID will be a distant nightmare. And so he's still trying to think through, what are those mega trends? Now, I think COVID has been an absolute accelerator for a couple of things that we've all been talking about. I remember I started one of my venture funds about 15 years ago, and I said, I really want to do more health tech and ed tech deals. And we actually did way too few then. And I think the next one I said was gov tech. And then I missed out collaboration tools. Probably would have been, if I was super smart, I would have said that as well. So I think those are the things that are absolutely being accelerated now. I think their time was sort of coming anyway, but that's always the best moment for these. So you're seeing the sort of, we're all on Zoom. We've all seen the numbers from Zoom, from 10 million users to daily to 300 million. So those sorts of things are absolutely accelerating super fast. But just to also get back to sort of one of the core themes, which has been startups in general and why they're sort of worth saving. The UK has 30,000 startups, which employ nearly 330,000 people. And to your point of should we be worried about startups, 41% of startups globally have less than 3 months of runway. And of post-Series A, 34% have less than 6 months. And VC deal activity is down 16% in Q1 versus prior year. But that, I think, is most of those deals would have been in conversation well before COVID. So I think Q2, I'd expect to see that number 30% or more down. And then the next point that's been identified by some, but not on this call yet, is that we said that VCs have a lot of money, but even on a call yesterday, whereas on with a representative of the EU, they are looking to put more money into venture funds because they think a lot of LPs will default. Because one has to remember that while venture funds say they've got 2 billion or something, it doesn't mean that money's sitting in the bank. And it's particularly possible that in this environment, their investors will default. So there's some government intervention that the EU is looking at there.
Sorry, Brent, can you just explain that? I haven't heard that before.
So, sorry, the point is that if I say, like some people have done recently, Lightspeed just announced 4 billion, Index just announced 2 billion of venture funds. With some funds, and I don't know the quality of those LPs in those funds, I'm not talking about that in particular, but these are the money, when you say, I'm going to put 100 million in your fund, you don't do it immediately. That money is drawn down as the fund needs it. So the worry now is that the people who've promised and committed to that money will actually default, and they will say, when their capital call comes, when they're asked, put another 10%, put 10 million, put 10% of 100 million down, the money won't be there. And they'll say, sorry, we don't mind. We'll take the penalty hit, but we haven't got it.
Interesting. Okay. And Brent, I'm just going to stick with you for a second, if I may. I know that you've been involved and, engaged with the Treasury in the UK, HMRC here, around the government's intervention to try and support startups. The Chancellor Rishi Sunak announced that on Monday. It feels like ages ago, but announced on Monday. What's your read of whether or not it is going to be effective or successful?
Okay, look, really good question. We've been working very hard on that with lots of others, including Codec, which Jeff, I believe, chairs, and Dom Hallis has been instrumental, as has Dan Korski and John Spindler from Capital Enterprise. So, we have been lobbying for this fund, basically highlighting the need and trying to get away from this idea of special pleading. So the first thing to note about it was the instrument that I recommended in the op-ed I wrote for the FT about a month ago now was a convertible loan note. And that means that the government should get equity in these startups. Why? So that even if 90% say fail, it's like a venture capitalist, the 10% that win can win big for the government and compensate them for the losses, because we do agree the early stage, a lot of these companies will fail. Now, the next question is, really it's about, is the government being too cautious about how it's going to distribute this money? So the biggest concern from the industry, and many people on this call, will be, this is a 250 million pot of government money to match money. Is it only going to match the existing VCs, or is it going to match the angels and EIS funds? Now, we are very keen that it should match EIS funds, EIS investors, private investors. So private investors, I think the number is something like 20 billion has been released into the market by this EIS scheme, the tax scheme that benefits private individuals. So we've been keen from the get-go of this that any government money would unlock private capital. So it seems like they're answering the wrong exam question if they don't ensure that that happens. We are still optimistic as of today that the scheme will be adopted to allow EIS money in. To date, it doesn't. So that's one of the biggest concerns. Now, take that away. The other thing people on the call will be saying, well, I have to have raised £250,000 to date. We did ask for a lower amount, in fact, £100,000. We do, however, understand that there has to be some gating item for the government to protect against fraud and other things. What the government, I think, would probably say is that if you are a deep tech company and you haven't raised that amount of money, there is an additional 500 million released in this program from Innovate UK in grant funds for deep tech and life sciences companies. And I think they've said that'll be well over another 1,000 new companies that will get that. So I think you combine these measures, we're still very optimistic. We'd also love to see some of that 250 million, again, partitioned off for the earlier stage, for the real seed stage, because I think there is a debate amongst whether these Series B and C companies, where there is still lots of venture capital around, the best of them will already be able to get it. We think there's a whole class of companies in the super early stage where it's too hard to know, and there are too few seed funds that will touch them yet because they haven't maybe got product market fit yet. And we need them for the future. It's also key in that the rest of Europe, since we initially put out these proposals, Germany, France, Netherlands, Denmark, and others have come out with support for their early stage startups.
Okay, Brent, thank you. I'm going to come, if I may, I saw that Peter Sugarman had his hand up. I'm going to come to Peter because there's a lot of concern for those people who are not necessarily directly engaged in this world. The EIS, the Enterprise Investment Scheme, and I'm probably going to get this wrong, but the Enterprise Investment Scheme allows people to invest their money, and in the event that the business that they're investing in goes bust, actually a larger amount of that investment can be written off for tax purposes. So it's a much, much better way of being able to put money into the risky business of a startup. And a lot of people who are UK citizens, UK residents who are trying to invest do so through that EIS scheme. Peter Sugarman, are you still there? Because
yes, I'm there.
So what's your view on this?
Well, I think the scheme does need to be changed slightly, because one of the provisions of the EIS scheme is that you cannot convert a loan into qualifying EIS shares. And the convertible is, as the name suggests, a loan which converts into shares. So since most small companies that have not yet taken in VC funding are funded almost exclusively by private investors who will all have invested through, or nearly all will have invested through EIS. And those are the only investors that that particular company will be able to attract funding from at this time, because they're the only investors who really understand that business and can react quickly enough. And they're going to be very unenthusiastic, in my view, about an investment in a loan structure which cannot convert into an EIS qualifying investment.
Brent, do you want to address that?
Yeah, I mean, sorry, I apologize. I thought I did address that. We totally agree. It's been in our proposals from day one, and we have actually we have found simple ways for the government to enable EIS investors to participate in the scheme. Now,
and
the
Brent,
question then is, does the government want to, do they feel that it is too risky to allow those really early stage companies in?
And what's your read, Brent, on whether or not the government is, I mean, as we've seen with Rishi Sunak, he does tend to move on these things. Is your expectation that he's going to move on this too?
It's a very live point. I think there are lots of people in government who would like to move on this. We were surprised when we saw the term sheet come out on Sunday, last Sunday, that it did exclude EIS and SEIS. So I think it will just be a question about how cautious there will be people in the Treasury who are understandably cautious, and from their point of view, they're thinking of what is the Daily Mail and the Guardian going to write when some of these companies go bust, having taken government money, and they were only qualified because a few EIS investors backed them. That said, we think that risk is worth taking. And again, some people on the call have still not quite understood the point that this is from the chat, reading the chat post, that the fact that there is a high failure rate amongst early stage startups is baked into the scheme. So the government can still make money if it converts into equity, which is what happens in the scheme. You just need a small percentage of winners to compensate for the large amount of losers, and then the government makes money. And then you have to look at the scheme as it's not either this or supporting the NHS. It's a way for the government, hopefully, to make money, and therefore it's not an either or.
Okay. Brent, thank you. I'm going to come back to Jeff in a moment, if I may. But Jeff, before I do, there are a couple of people who've got their hands up. Claire, I see you've got your hand up.
Yeah.
Do weigh in.
Yeah, thanks. I'm representing a startup which is currently raising 15 million, so more, later stage. Brent, you mentioned the term sheet has been published. Do you know the timeline for getting more details, terms and conditions? Will it be on a specific website? Or should we go always to the government.co.uk website? Do you know how this scheme is going to basically be put in place in practice? And when will we know full details?
So the draft term sheet is public. I assume there's a link from the government site, but it's been all over my Twitter and LinkedIn, the link to it as well. When will there be more detail on it? I mean, I don't know how much of a confidence it is, but we would expect something next week.
Next week. Okay.
Thanks, Brent. Jeff, what do you make of this? I suppose I think we've addressed the concern about EIS, the concern about the fact that certain investors can't get engaged as things currently stand. But what's your read to the bigger picture of what the level of government support has been and the process of it? Are you worried, as it seems there is in the chat, the worry that the intention is good, but the results are not likely to be?
Well, look, I think the package that was announced by the Chancellor on Monday is very much something to celebrate. I think the hugely hard work that Brent, that Dom from Kodak, that a number of other people put in to conversations over the last 4 or 5 weeks to get to where we are was fantastic. I think, it is a great step in the right direction. I think by all accounts, the Chancellor and the Treasury team were receptive, understanding of the need, and worked hard to craft something that worked well. There are obviously these open issues that need to be settled. I think, it is worth noting that the French and the Germans moved a heck of a lot faster, and that is, I think, an observation, but we got there. I think that, it all comes down to execution and delivery right now. On one end, I think the execution problems that we've seen in the loan scheme, C-bills, for, which are for debt eligible SMEs, are concerning. I know there's been a lot of pickup to improve that in the last few weeks, but obviously that's not sort of the most, the ideal precedent. But at the same time, I think the framework that has been adopted here for the Future Fund is one that should be executable and deliverable effectively. So I'm optimistic. I'm cautiously optimistic. And as Brent says, there are a number of live conversations, both about the details and about exactly how some of this will be rolled out. So I think we will know much more in the next couple of weeks. I do think, though, that one of the concerns that is going to come up is going to be the overall quantum. I mean, I think 250 million is a fantastic start. And I think that it is going to help a number of businesses get through this period. But one of the great things in my mind about the economy of the past decade is that we have gone from really a very small and niche startup ecosystem to a really quite large and vibrant one that has a huge number of businesses from pre-seed up through venture stage and beyond, that have massive potential. And if we're trying to maintain as much of that as we can, it's not going to be inexpensive. It is, as Brent says, going to be profitable for the government. I'm absolutely convinced that this fund will be accretive to the Treasury, and the government will make a profit off of it at the end of the day. But it requires an upfront commitment, and I think the 250 is probably going to be gone through fairly quickly.
Okay, well, that's helpful both in the substance and in the spirit of it, Jeff. I'm going to bring in Bruce Davis, who's got his hand up. Bruce, do you want to weigh in at this stage?
So I guess speaking on two fronts, one of them as Director of UK crowdfunding, and firstly, we're very supportive of all the efforts across the different groups that have got together to try and raise the profile of this sector of businesses and the support that they need. And then in my other role as Abundance, we're also looking at this and our pipeline and how it's been affected. I guess on the first point, I think the government is learning perhaps a little bit the hard way that different businesses have different financial needs, and then perhaps the one-size-fits-all approach was a sort of an oversimplification. And I think at the moment we still haven't got a sort of mature enough debate around the types of money that needs to go into businesses and what money businesses can actually accept, and particularly the sort of equity stakes of businesses that can't take on debt. There's very much we're having a debate about how this is going to get paid back before we've actually paid it out, which I think is a little bit cart before horse. I think on the other side, I think we're seeing quite strong demand for investment from sort of newly strategic sectors. To pick up a little bit what Brent was saying, what are the sectors that are coming through? So food production in the UK there's huge numbers of projects coming through as people are starting to realize that our supply chain is somewhat exposed. And I think that Brexit started that process, but this has actually emphasized that. And on the other side, just infrastructure generally. So seeing entrepreneurial startups coming into infrastructure and speeding up, so broadband rollout, lots of different areas and lots of businesses wanting to raise money. And I think the question we've got to ask ourselves is, are we getting ourselves prepared for what needs to be done to support the sort of the investment needed to drive the recovery? So yeah, there's an immediate problem of cash, but what about looking forward towards the recovery?
Well, Bruce, can I pick up on that? And actually, if you like, go back to Kathy Gramotka, because I'm interested. Look, I'm struck. I wasn't aware of some of the risk around some of those funds, and the point that Brent made about LPs not necessarily honouring their commitments. But let's assume that the money is there in some of these venture capital firms. Let's assume that what I read in the chat is right, which is you see a real collapse in early stage financing in the first half of the year, in whether it's seed or the early stage investment is seriously down. One of the themes that you see in the conversation that people are writing in is whether or not there's going to be this wave of new startups pushing, if you like, quote unquote, different use cases, different ways of life. And what do you think is likely to be the case? Do you think that we are going to fundamentally change the way that we do education? And therefore, from your point of view, Kathy, you look at that and think this is going to be a rich seam, or do you actually take the view that there are going to be very, very few winners in that, and they're probably already established?
It's interesting because we're sector agnostics, and in my portfolio, I've got a education business, I've got several e-commerce companies, I've got several enterprise SaaS businesses, and they've all been impacted, but we see actually a positive impact across all of those sectors in a way that we wouldn't have anticipated. So our education business is seeing a 12 times uptick in usage and engagement. The hope being that some of the schools that have been a little bit more reluctant and less tech savvy have now actually leapfrogged some of their best schools and been forced to adopt technology in a way that would have maybe taken them 5-10 years to get to. So we're actually really, really excited about that side of the education space. And then on the e-commerce side, we're seeing new customers buying things online that previously would have been hardcore bricks and mortar. I only buy stuff I can touch and feel and see rather than trusting something I've bought off the internet. So we're actually quite excited about the impact of COVID on the e-commerce space as well. And then in the enterprise software space, naturally sales cycles take longer as businesses are clamping down on non-essential spend and clamping down on what they would consider, pilots and trials of more innovative technologies. But at the same time, there's also this curiosity of online collaboration. So some of our businesses that cater to that space are seeing an uptick in engagement. So we're actually pretty excited about the future of a world where people are more used to transacting and communicating online off the back of the forced lockdown.
That's interesting. That's interesting. Can I just ask Jeff, if I may? I'm going to come back to you. Pete Sugarman's just raised this question, and I'm sure there are a lot of people on this call interested in the same question. It's about what you think in terms of your perspective on startup valuations over the past month. Have you, Jeff, just sort of shelved that as a way of thinking and said, look, there's no real way of making a valuation of a startup right now? Or do you think that those things have fundamentally shifted or in a hiatus? What's your view?
No, look, I think there is absolutely a shift in valuation. I mean, I think one of the realities about startup valuation in any market is that it is not a precise science. It's probably not a science at all. It's very much a market-driven concept, and in frothy markets, valuations go up significantly. In less frothy markets, they come down. And now is not any different than that. What we're seeing on Cedars is very interesting. We have long had an interesting mix of businesses where the majority, I'd say 70 to 80%, seek to raise money at what is, in our mind and based on our understanding of the market, a reasonable valuation, and then maybe 20 to 30%, try to stretch their valuation. And in very, very booming, busy markets, sometimes those 20 to 30% succeed. Often they don't, but sometimes they succeed in raising capital. They're not now. People are, investors are wanting to see reasonable valuations. That doesn't necessarily mean deep discounts as a result of the crisis, because these are long-term investments and people understand and believe that these companies will have meaningful value on the other side of it. But this is I think, a moment in time where we're cutting back on some of the froth, and that in and of itself may not be a bad thing.
Okay, well, that's interesting. I see that Amy Lewin has sort of said there's a note here that puts valuations down 10 to 30%. That was quite an interesting thing from the conversations that she's had. Basha Carey, can I come to you? Basha, you've got your hand up. Hello.
Yes, sure. So as a founder myself, and having bootstrapped my startup to date, and having raised over £800,000 from family and friends, my sort of question is around, we're just about to actually, do a Seeders campaign. We getting that ready at the moment. But my question was also around, from Brent, if you want to answer that, Brent, is the 250K from, the criteria being from private investors. What does private investor mean? 800K that we've raised, is that good enough to show that we've raised over £800,000? Whether that's from family, friends, or, a bootstrap to date.
So, and Bash, just out of interest, what's your business in?
So business is called Green Wallet, and Green Wallet is all about bringing sustainable, shopping into the hands of people, and also we're bringing an ethical banking element into that. Right. So it's all, and with every purchase that people make, we show them the impact, the positive impact they're creating by planting a tree. With every transaction happens in Green Wallet. So it's an app-based marketplace where we found that, there's an explosion of sort of, green products, vegan products, for example, are coming into the UK market and the world. And that's creating sort of that, fragmented shopping experience. People trying to buy sustainably, people trying to buy, find these products, but it's not easy to find them in one place. So we have brought them into one place, and an experience where people can find them, purchase them, support those businesses that stand for change, and also at the end of it, we've created a reward systems called Green Coins that people are rewarded with every purchase, as well as a tree planted in their name. And so it's something that brings everything together, and we're excited about it, to bring that out into the market and for people to, but it's something that we were just about to get out there, and obviously COVID is just.
I saw Basha. So there's a note as you were speaking to someone called Sam Cry, who put a note in saying that they were just at the moment of closing their seed round, that 3 of their angels pulled out. They still managed to get the round off, but had an impact on valuations. I'm going to do 2 things if I can. One is, Brent, do you want to just answer that specific point about whether or not Basha's £800,000 will count? And then if I can, I'd like to come back to Check Warner just about this broader valuation question and what your read on it is.
Sure. I think today what they've said is it's FCA regulated, I think, money coming in. I think, again, it's still not, that there are some conflicting signals coming out of the BBB, who are obviously going to be administering this, and to whether they currently really just want to match venture capitalists. But our understanding is that today, if you've raised 800K from private individuals, so long as they are, some of them I think are FCA registered, I think it's only some of them, then that counts. One of the big questions scheme today is, if you have bootstrapped your business to date and haven't, this isn't your case, and haven't raised any money, then technically at the moment you wouldn't qualify, even if you found a 250K, £250,000 today. But we're hopeful again that that's a sort of omission and wasn't intentional, and that if you have a good business, you've raised 250K, then you could get a match. But in your case, if you could now raise 250K from some FCA registered people, then our understanding is you would be eligible for the match. And then it just depends on the more deterministic criteria and who gets through, and the rest of the process, which I think the BBB is still working on.
Okay. Chet, can I come back to you on this valuation point? Because I was really, I'm struck that you may have seen the message in the chat here from Daniel Doll Steinberg, who just makes, the sensible observation that the startup valuations are going to depend on exit prices. And given that there's not going to be a great deal of bullishness for a while, that surely is going to depress valuations now and for the foreseeable future. What's your read on it?
Yeah, I mean, I think the slightly tricky thing at the moment for us talking about this is that we don't have the data, all the data is trailing on valuations, but as Amy points out, sort of, she thinks valuations are down by 10 to 30%. I think in public markets, stocks are down, you know, anything from 10 to 50%. So that is going to affect valuations. But I think there are sort of 2 points. One is that round sizes are also decreasing. And that's one of the things that investors are doing, saying, look, I can only meet you on Zoom. I can't really get the level of conviction I would have otherwise had been able to get if I was meeting you in person. Therefore, I'm going to chop my check size in half, and I'm going to give half of it now and maybe half of it later on if you do well. So that sort of reduces the round size, and that actually affects valuation because it reduces the valuation because you're still kind of wanting to buy anything from 15 to 25% with the same round size. So that's one kind of aspect. Another aspect is this convertible loan note sort of scheme. You know, while it's brilliant in some ways, it's also going to distort valuations quite a bit, because one of the things about convertible loan notes or any loan note is that you don't define the valuation at the point where you get the investment. So the valuations are not actually going to be kind of crystallized until next year or whenever that loan actually converts. And I think that there's a real risk that some of these founders who are not familiar with the structure of convertible loan notes will kind of dive into it and actually not realize that they may be getting priced when it is a price round in a year's time. That actually is a very dilutive amount of equity that they took in this convertible loan note. So I mean, they were not a normal instrument really in the UK, much more of a kind of US instrument. And I think that the widespread use of convertible loan notes is going to have an impact on early stage valuations for sure.
And Chet, can I just ask you, what happens then in the world of investors? Because we do, Tortoise, we do these calls now every day with the CBI, with the Confederation of British Industry, and it's really striking. The more you're on these calls, the more you realise, obviously this thing affects people differently, different sectors. It obviously affects people differently by geography, but it's really clear that it affects people depending on how big you are, right? So the big look as though they're in much better shape to deal with this than a small. And I imagine on the investment side, that's true too, that if you've got a fund, if you know it's going to be paying out over a bunch of years, the big investors, the big private equity and venture capital firms are just going to, you know, maybe this is oversimplified, they're going to clean up, and the smaller ones are going to be much more fragile. And that's going to have an impact, surely, on the kinds of people, the kinds of businesses that can raise money.
Yeah, I think so. And I think this is the risk with any kind of government scheme and the sort of fear of taking risk in general, that sometimes it just means that the winners or the existing kind of big players actually get bigger and get more robust and better funded, and the ones that are kind of slightly more on the edge or doing slightly riskier, sort of more out there things actually get kind of wiped out. And a really important point, which we haven't sort of talked about, is that a lot of the very, very early stage companies who may not have raised £250,000 are much more likely to be the ones founded by female founders, founders from outside London, diverse founders. And there is a real danger that with this massive injection of funding that's coming in, which is fantastic and we need it, but is going to exacerbate the problem we've got within tech, which is that you've got a lot of the founders of, you know, 90% of tech companies in the UK founded by all male teams. It's very white, it's very privately educated, it's very London centric, and that we're just going to exacerbate that with this scheme.
Yeah, okay. I can see that, Brent, actually, you seem to have your hand back up, so weigh in. What's on your mind?
Well, sorry, I've been putting it in the chat. No, just the point about dilution on convertible loan notes, and I'll just quickly say what I was writing.
Brent, convertible. You explain it slowly so that someone like me can understand.
Okay, sorry. So the point about dilution on convertible loan notes, I feel compelled to sort of defend this instrument again, as we have been championing it from the get-go. It's not that new an instrument. So even in the UK, I'll just say I used it in 1998. It was recommended to me by one of our investors, and the point was we hadn't proven enough as lastminute.com. We spent all the money within about 9 months of raising it, and we were like, uh-oh, what do we do now? We don't want to price around now. It'll be too dilutive. So one of my wise investors, Tom Teichman from New Media Spark, said, let's just do a convertible loan note rather than pricing something now. Let's price it in the future. And if you're as good as you think you are, the price will be much higher later on. So this instrument protects both the founder and the government. And what it does is there's a 20% discount to the next round. But the point is, if somebody raises that next round and they've got up to 3 years to raise it, can they not prove a lot to get a much higher valuation? But the risk is actually that the government invests at the low point now and should be getting price rounds, is what other people would say. So what is in the terms is that if the private investors say, okay, we don't just want to take the risk now, we want to have at least a cap, an upper limit on the convertible loan notes, then that is possible, and then the government will get the benefit of that as well.
Okay, Brent, thank you. I think I'm with you. Can I just go back just a final point, just to go back to Jeff Lynn at Cedars. Jeff, I know that you sit with a number of hats. One is your sort of with a Cedars hat, but obviously as the chair of Codec. What you've seen around the CBILS, the Coronavirus Business Interruption Loan Scheme, is that the government came out and said, we'll do whatever it takes. And then in the last 3 to 4 weeks, actually the money's just not going out the door. You know, it's been, 1 or 2 billion out of an amount of 330 billion that's earmarked for this. How worried are you the same's going to happen here with support to startup and the enterprise economy? That the rhetoric will be great, but the execution is just not going to be fast enough. And as Brent said right at the beginning, the runway for these companies is just 3 months. How concerned are you about that?
Well, the great thing about the startup world is nothing is ever fast enough. The chancellor announced this on Monday morning, and by Monday afternoon there were complaints that money wasn't out the door. So I can guarantee that it won't, that we won't all be satisfied. But I think we've got a couple of things with this package working in our favor vis-a-vis the CBILS. One is the institutions who will be relied on to deliver it. I think part of the challenge with CBILS is that it has largely, until very recently, been reliant primarily on traditional banks. And this isn't getting into bank bashing, but I think it's an accepted fact that the legacy systems and operations that many of these institutions have were not particularly well set up for the volume and speed at which CBILS was going to operate. I am optimistic, perhaps cautiously again, but optimistic that the people who are going to be delivering this, be it the British Business Bank and whoever they work with on the government side, as well as the private match funders, whether that be VC or individual investors. I agree fully with Brent that it's critical that match be able to come from EIS and SEIS investors. I think these are leaner operations and operations that are going to be able to move faster and in a more responsive way. So I think that is a key part of it. I think another important part of it, frankly, though, is that this has been a really good example of the startup scale-up ecosystem really coming together to put some, to show government how important this is. In my role as chair of Codec, which I co-founded 10 years ago, I've spent a lot of the last some years sitting around government tables talking about fairly esoteric aspects of tech policy that don't concern a whole lot of other people. This has been a moment where VCs, where lobby groups, where tech representatives and so many others have come together and really, I think, made very clear to the Chancellor and others just how critical this initiative is. And I think, the fact that they've listened and the response that they gave is encouraging. So is there a risk? Absolutely. As we all know, as any entrepreneur on this call knows, nothing's done until cash is in the bank. But I remain optimistic that this is going to be a significantly faster, better, more well-oiled machine than what we've seen from the CBILS.
Okay, well, Jeff, thank you. We're trying to keep to time, and it's coming up to 2 o'clock. If you've been to a think-in in our newsroom at the Tortoise newsroom before, and now increasingly our digital newsroom, you'll know at the end is the job of whoever's editing that day to try and make sense of what we've heard. Obviously, there's been a huge amount of kind of both big picture and detail. I would come away with, I just think, 4 things that are worth really thinking about. One is, I think I really took a view on time listening to everyone, i.e. the next few months, probably this year, there's going to be a good deal of bearishness. I know Jeff talked about the lost year, about Brent being very bearish at the top, Kathy saying actually just suspending a judgment for a matter of months. But I thought there was something really useful and clarifying about the conversation that Brent had in terms of talking to an investor who says, think about what the world will look like in 2025, the 5-year view. So time was one thing. The second is, I think that there's a level of politics here which we probably just sort of scraped past but didn't really touch on enough. I think Czech Warner's point about the extent to which big VCs over small VCs will have an impact on the kinds of companies that win, the kinds of people in those companies. I think there's clearly a really big issue I saw in the chat about the sort of public acceptance of risk in the VC, of government money going into startups, given the pressure on universities, on health service, on social care. There's a big political agenda around that. And so I think that politics is going to play in this, and it's probably going to play more rather than less in the coming weeks. And then third, I think, was just how much do we believe we're really going to change? How permanent is the change going to be? I thought, you know, Bruce's point and Czech's point and Kathy's point too about the kinds of investment, Julie and Asher made the same point too, that you're looking at new possible investments in education, in transactions, in food production. These, I think, seem like the big judgment calls, and whether or not the already incumbents going to make the most of it, or whether there's room for new entrants is a big question. And then fourth and finally, it's really interesting how much we've really focused on the small print. And I think, you know, this is obviously the thing that, you know, many people, particularly you, Brent, have been involved in. You know, what does it mean to be FCA approved? Can convertible loans qualify for the EIS? What about this 250k limit? I know there's a lot of work going on with the Treasury, but clearly this is material and very significant to people. So I hope that we have, by listening to lots of people, made a little sense of the situation that startups are facing. Thank you very much, everyone, for joining. If you're not a member of Tortoise, here's my plea as a startup. Please do join up. You just sign into the Sensemaker newsletter every day. You'll get some of our journalism, or better still, become a member. We've got a 30-day free trial. You can get all of our journalism. It would be great to have you with us. Finally, a thank you to Brent, to Jeff, to Czech, and to Kathy too. We can't applaud each other, but we can wave. So a farewell and a happy wave. Have a very, very good weekend, everyone. Thanks so much for your time. All the best.